Hi, everyone. I'm Casey O'Rourke here at Fross and Fross Wealth Management. Pleased to bring you today's topic of conversation, which we talk about a lot each day that we visit with you, and that's the required minimum distribution. Also stands for RMD for short. And we're going to talk about why that's important and why you need to be aware of having a plan in place so that you can avoid some penalties. And so it matters most for those that are approaching retirement. As you get to a certain age, the IRS says you've deferred long enough. Now it's time to start pulling the money out. And we're here to help you formulate a plan to be the most tax efficient and also for longevity and for your investment returns, as well as having a structured plan that you can fall back on. And so this also applies to those that have inherited qualified assets, such as a traditional IRA. There are certain specific rules that you must follow as well to avoid those big penalties. So again, what's an RMD? Essentially, it's the required minimum amount that you must withdraw from those tax deferred accounts each year when you reach a certain age, or if you've inherited it. And so the current age, which I'll get into a little bit more detail, to go back prior to the Secure Act, before 2020. The RMD age was at 70 and a half. And then Secure Act 1.0 came out in 2020 and they raised it to age 72. Well, then Secure Act 2.0 came out in 2023. They raised it again to age 73 for those that were born in 1951 through 1959. And then starting in 2033, if you were born in 1960 or later, your RMD would be pushed out to age 75. And so why does that matter? You have to take, or should say you must take your required minimum distribution by December 31st each year, or face a pretty steep penalty of 25% on the amount that you were supposed to withdraw. So there are certain provisions that you could have that decreased, but frankly, it's better off get a plan in place to make sure that you don't miss it, and have it be the most efficient for your overall financial plan, whether that's for tax purposes or for certain life events or purchasing, planning vacations or big purchases. Whatever it is, have a plan, talk to us, let us know how we can help. For those of you younger beneficiaries, if you've inherited an IRA, you might not be of RMD age, but you still have to follow the rules. Most non-spouse beneficiaries must empty the IRA before the 10-year or by the end of the 10th year following that person's passing. And if the original owner started taking their required minimum distributions, then you must follow suit for years 1 through 9 and have it completely depleted by the end of the 10th year. So there are certain provisions and flexibility for those like eligible beneficiaries that, such as a spouse or a minor child, might have a little bit more flexibility in stretching those distributions out over their lifetime. But I would recommend talking to your advisor if you have questions or want to get into details of what it looks like for you. Just let us know. And so here's what to do. First and foremost, confirm whether or not you're of RMD age, or if you've inherited a qualified account, what that looks like. And then number 2 is take the RMD. You could take it out over a monthly basis, a quarterly basis, or some investors like to push it out into the fourth quarter with the assumption that the market will be higher then. There's no guarantees. We've been hit by this a couple of times in a couple of years. 2018 brings back a memory, and the fourth quarter was not a favorable time to be pulling out your RMDs. So it's probably best to come up with a structured plan, even account for those short-term needs, have that bucket of money in a conservative investment where at least you have the first 1 or 2 years of RMDs set aside, still earning something hopefully, but having that available without having to sell at a low would be the prudent way. And so last but not least, if you inherited the IRA, just make sure you're following the correct rules of the 10-year rule, what the annual requirements are, how that looks as far as taxation. And if you don't need it, a lot of retirees say, hey, I don't need this money. I have plenty of cash in the bank. What should I do? Well, the easy answer is you take the distribution, we move it into another account, reinvest it. It's more of a lateral move. You pay the tax and move on. So if you have questions, feel free to reach out to us, talk with your advisor about upcoming plans, upcoming expenses, and how that looks for you, what makes the most sense, especially if you are 71, 72, approaching that retirement RMD age. And so we could plan around that. So thanks again for joining me today. I'm Casey O'Rourke signing off. Have a wonderful, happy and healthy new year ahead.